Hello, this is Steve Malone with Compass of X. I hope you're doing well today and you're getting some good trades. In yesterday's video, I talked about an intraday range trading strategy. And from that, I've gotten some emails asking me about the effectiveness of the strategy. So today I thought, let's go back over. Let's take a look at where I left off yesterday because there was a couple of setups I talked about and see what took place. And we'll look at some other scenarios that took place today. Now, here's what we're looking to do. We're looking to trade reversals off of overbought, oversold conditions seen in the Trader's Dynamic Index. Now, for those of you not familiar with the Trader's Dynamic Index, it's an indicator that I developed a number of years ago that shows market sentiment. And you can download the Trader's Dynamic Index in the Synergy Trading Model. Simply go over to www.compassfx.com/synergy. Here's what we're going to do with the strategy. There's a few simple rules. First off, in the Trader's Dynamic Index, you want to place an 80 line and a 20 line. And what we're looking for is the Trader's Dynamic Index green line, is referred to as the RSI price line, to get above 80 for an overbought condition or drop below 20 for an oversold condition. Now, we'll be looking at a few other things, but primarily that's the first thing we're looking for. Another thing we're going to be looking for is confluence out of price. What I'd like to see in price is divergence, and that would be regular divergence. And this is an instance of that. You have higher highs in price, but the green line of the Trader's Dynamic Index has lower peaks. That is an indication of a potential reversal in the market. So there are two things we're looking for so far: above 80 and negative divergence. One other thing that could be good for you with this particular strategy is when this occurs in close proximity to some sort of news event. And if that news event is in favor of the direction of the reversal, even better. So yesterday we had a beautiful setup. We had overbought, we had negative divergence, and we had an economic event that was negative on the euro, and we had the strong move down. And what we're looking to do is enter our trade short somewhere between 68 and 80 and looking to exit the trade somewhere between the 32 and 20 when we're going short, and just the opposite when we're going long from the lows. Now, there's a couple of other things I wanted to point out to you. Be careful in where the market baseline is at. See, the market baseline is usually right around the 50 level. That's about home base or home place, the neutral position. And when you're way up high like you are in this case, and this is sitting about the 50 level, and the overall direction of the market baseline is not in the direction of the potential reversal, be careful. In this case, we can see that the market pulled back a little bit, not much, but you can see that the market resumed back to the upside. So what I like to look for is that market baseline is getting near the 68 level or at the 68 level when looking to trade the overbought condition. And just the opposite, I'd like to see the market baseline to be somewhere near the 32 or at the 32 when trying to catch the oversold condition and trade long. Now, let's take a look at a situation we have where I left off yesterday. You can see that this was moving up higher, but notice that over here we were starting to get a bit lower. So if we move across, you can see that we get a higher high in price, but yet we get a lower peak. So in the Trader's Dynamic Index, we can see that in this instance that this is a potential divergent situation, and in a regular divergence or negative divergence scenario here, we're looking for the market to push back down. Now I'm going to watch price as price continues to move on the other side of what's known as the price action channel. So this would be somewhere close to an entry point, and the beautiful thing about the synergy model is when price action and market sentiment are showing the same direction, you have a higher probable trade. So in this case, we're looking to enter the market somewhere right up in this area. And let's just take a look at what took place. As I move along, what I'm looking for is a couple of things. I'd like to see that the green and the red stay pretty much below the yellow, but I also want to see the yellow line starting to sink down. Now, you want to set your stops accordingly use proper money management. And what I would do in this case is set the stop loss up above the high point right here. Okay? And now again, we're trading reversal, and be careful when trading reversal because the market could turn on you. So have proper money management and proper stops. Okay? Now as the market continues to move across, we can see that it finally drops down into that 32 to 20 area. So the market gets right down into that area here, but hasn't hit 20 yet, and the market baseline is still descending. So if we hang in there a bit longer, let's see if it gets all the way down to the 20 level. Now it didn't. It started turning back to the upside. So this trade didn't result in a lot of pips, but think about this. We're from about the 34.80 to about 34.65, about a 15 pip trade down on the 5-minute chart. That's not too bad. If we keep on going, you can see though that the market eventually dropped lower and pushed down. Let's take a look at another trade that I had a step on yesterday as I was wrapping up the video. What we were looking for in the Traders Dynamic Index is what I refer to as the hook. And the hook is when you have a situation, it's like a fish hook, the market's turning over. And it's preferable when the market's turning over above the 80. Now in this case though, what I was looking at was I was watching what price was doing and looking to see if we got any follow through in price. Remember on the euro dollar, back over here on the euro dollar, we were waiting for that market to break and hold below the price action channel. So in this case, I'm watching this and I'm going to watch to see if price will stay below. In this case, it didn't stay below, it went back up. But notice what happens here. As the market rolls over, it finally holds below here. So let's say we entered short right in this neighborhood right here. Again, what I'm looking for here is the Traders Dynamic Index to move down between the 32 and the 20 level. And it finally does hit right in that area for a nice little move down. In this case, let's just take it from the close right there. That in and of itself is about a 30 to 35 pip move. If you took a little bit lower, maybe a 40 pip move, let's call it about a 35 pip move. A nice little trade going off the reversal here at the top. So again, we had the setup where we're overbought based upon the Traders Dynamic Index. We had the beautiful divergence. Now I'm waiting for the market to come across and show that it's going to go that way. I know some of you who've written me have talked about, is it possible to enter at the top when I see this hook? The only problem with that is, see this hook, see where price was at, and look what price did. It went higher. Again, a hook above, and price went higher. Just because the Traders Dynamic Index goes above 80 doesn't necessarily mean it's time to get in. Look for that divergence indication, and we had it here. Let me go over and show you one other one. It was on the Aussie dollar, and this was a nice setup again, and this was probably the textbook perfect look that I would look for. And you can see in this case right here, we are above the 80, and look also where the next little move up, again, we have divergence here, beautiful setup here. Look at that, the peaks, but also notice, see a lower peak here, higher highs in price, lower highs here, but look also right here. That is a gorgeous setup. That is textbook setup. You have the market baseline above the 68. You have the green line dropping below the red dropping below the 68. Beautiful setup right here. So the possibility of entering the trade, and look, see how price comes down? Back below the price action channel. So let's say we entered the trade right in this neighborhood, and then I'm waiting for the trade to get down somewhere between 32 and 20. We could have exited anywhere in this area. This one hit right about there, so there's a possibility we could have exited right there. That'd have been about a 20 pip. If we exit a bit lower, this one right here would be about a 25 pip trade. Then the market kept rolling on down, and it's something I look for as I trade is if this guy's continuing to roll down, wait till it crosses over. If we had waited for the crossover, the Traders Dynamic Index, look what that potential reversal trade would have done for us. That right there is about a 60 pip trade or so. 60 pip trade, I'll take that all day long, and that was simply based on a reversal. So is this an effective strategy? I think it is. I think you have to look for some key components. Look for the market to go beyond the 80 or go beyond the 20. Look for the market to have regular divergence, so that's an indication of reversal, and also look to see if there's any other economic events that could help be the driver. And one other thing, especially for those of y'all who trade the synergy model, look for price to come across the price action channel and continue in that direction. Don't be too hasty to jump on when this is sitting up high, because you could get yourself caught in a situation where the market pushes up higher. Well, this is Dean Malone with CopsFX. Hope some of the information I've shared with you about this intraday range trading strategy will help you in your trading. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.